Steve Hanke returns to the show. He is a professor of applied economics at Johns Hopkins University. We'll be addressing some viewer questions as well as some of the latest news surrounding the financial markets and the economy. And as always, Professor Hanke will be giving his update on what's going on with the economy and his outlook. Thank you very much for coming on the show, Professor. Welcome back.
Great to be with you, David. I'd
like to start by talking about the petrodollar agreement or non-agreement, if you want to call it that. Whatever's going on between Saudi Arabia and the U.S., there's been a lot of news, reports on media, a lot of misreporting that I'd like to clear up with you. This article, for example, states that Saudi Arabia's petrodollar deal with U.S. expires with no new agreement in place. A petrodollar agreement with the United States and Saudi Arabia has expired. As per reports, the Gulf nation has decided not to renew the deal that expired on June 9th. This move can be seen as a global finance paradigm shift from the U.S. dollar as a reserve currency. The termination of the deal may also have implications and consequences for America. I've seen all sorts of these sorts of reports with pundits calling for the end of the dollar and the collapse of the dollar system as we know it. I'd like you to just respond to what I just read and provide your own thoughts and elucidate on what actually happened.
Yeah, what you just read, of course, it is complete rubbish, but it's all over the place. Now, I think my conjecture is most of the folks that are putting this disinformation out are crypto evangelicals, people in the cryptocurrency space. That's one possible source, or probable actually. Another one is the members of BRICS, or shall we say the Global South, or the anti-U.S. Geopolitical crowd. So you kind of have two things going on here. What actually there never was a petrodollar agreement, by the way. It never did exist. There was something that it was important, and that was we had the OPEC oil embargo in 1973, and in February of 1974, there was something established called the U.S.-Saudi Joint Commission on Economic Cooperation. And the reason that was put in place is that, of course, the money was flowing into Saudi Arabia as the price of oil had gone up after the embargo. And the Saudis just weren't organized. They literally didn't have the bureaucracy in place or the structures to even handle the money. So the idea was a broad range of things in this U.S. Saudi Joint Commission in which the U.S. bureaucrats would basically help and advise the Saudis on how to set up a bureaucratic infrastructure to run the economy, to not run the economy, but to manage the kingdom's finances, shall we say. So, and by the way, this kept up until for 25 years after the agreement. It was renewed in 5-year increments. And it turned out to be kind of a model that was used when the Soviet Union collapsed and the Iron Curtain came down, Eastern Europe opened up and so forth, and communism was swept aside. The Eastern European countries and the Soviet republics were in a little bit the same shape that the Saudis were in 1974 when they set up this joint commission. I mean, they really didn't have anything in place to manage a state that was operating kind of in a market economy or a modern economy. So since the U.S.-Saudi Joint Commission is faded away, well, all of the commission activities actually faded away before the end of the commission. But there was never any petrodollar agreement in the commission.
Okay.
So so and it does get into this whole de-dollarization thing, and you've got uh, actually the U.S. dollar is quite strong in terms of its reserve currency position. It's actually the central banks right now are buying dollars big time in reserves. The dollar invoicing is still very strong. Currency transactions, over 90% of all currency transactions have the dollar on one side of the transaction. And I've mentioned this before. If you go back 2,500 years, there always is one international dominant currency, for let's say 2,500 years. So it's always been a one. Before the US dollar was the dominant international currency, it was pound sterling. And of course, the UK got into trouble and overcommitted after World War I, and then things even got worse after World War II. And then the colonial system collapsed after World War II, and you had the sterling area disappeared. So you had a lot of mismanagement and so forth on the part of the Brits, and the challenger was the U.S. dollar, and the U.S. dollar took over really completely by about 1955, something like that, and is in the driver's seat as the international currency. And although there are things that make the dollar potentially vulnerable, like weaponizing it, sanctions, and things like that, but the reality is the dollar remains king and in the throne, and it's hard to knock a king out of the throne. Challengers have a terrible time doing it, and so far, if you look at the BRICS, it doesn't really amount to anything. Even the Chinese yuan, I mean, that China is the biggest country in the BRICS. You've got China, India, Russia, Brazil, South Africa, Iran, Egypt, Ethiopia, and now the EAU. But as a percentage of even official reserves, the Chinese yuan has fallen down to 2.3%. They were up to 2.8% of international central bank reserves. They're down to a piddling 2.3%. I mean, it's basically going nowhere. So that's the Saudi petrodollar story.
Before we continue with the interview, I want to tell you about another way to allocate your assets. Well, with alternative assets, stocks and bonds are far from the only options we have nowadays, especially since some pundits believe and have speculated that risk assets are now overbought. Our sponsor today, Masterworks, focuses on contemporary art, a segment of the overall art and collectible market that over 63% of wealth managers have already integrated into their wealth management offerings, according to a survey in Deloitte's 2023 Art and Finance Report. And their art investing platform makes it cheap and easy to get into the market compared to the usual barriers of entry with this type of asset class. In fact, Masterworks has distributed back a total of over $60 million in investor proceeds across their 23 exits to date. Masterworks offers blue chip paintings, specifically post-war and contemporary art, to investors in the form of securitized shares. Some of Masterworks' previous offerings include legendary artists like Picasso, Basquiat, and Banksy. By using my special QR code, link here on the screen now or link down below. Okay, the claim here is that whatever shift happened in June, and we could elaborate on this if you like, would have significant impacts on the dollar reserve status. So I'd like you to comment on this. This is from a note from UBS, Swiss Bank's UBS. Oil has always traded in non-dollar currencies. In January 2023, Saudi indicated it was happy to negotiate oil sales in other currencies. The possibility changes little for financial markets. Saudi Arabia's rial remains pegged to the dollar, and its stock of financial assets are dollar-focused. The dollar's reserve status depends on how much money is stored, not how transactions are denominated. Can you comment on this?
Yeah, well, UBS more or less was given a coherent summary of the reality is that nothing has changed because there wasn't anything to begin with. There wasn't any formal agreement. That's the petrodollar pact never existed, but de facto, in a way, there's a pact because that's the way they invoice oil, and virtually all commodities are invoiced in dollars as well as many other things, by the way. Now, in 2016, for example, Britain, the United Kingdom left the European Union. You had Brexit. So what happened? The US dollar was being used to invoice exports from the UK. About 35% of those exports during the pre-Brexit era were invoiced in US dollars. Now it's jumped up to 55%. So they leave Brexit, and what happens? They use the dollar even more, not less.
Bottom line, then, you don't see any imminent collapse of the dollar or a loss in the reserve currency status because of whatever is supposedly happening with Saudi Arabia.
No.
Okay. Well,
it's just it's
okay.
it's not in the cards. And if you look at very recent indicators of what central banks are actually doing with reserves, they're piling into dollars.
Yes.
You know, the old line, buy dollars, wear diamonds. It turns out to be really the real deal now. The dollar is very, very strong.
Do you anticipate the dollar to get stronger this year, especially with interest rate differentials perhaps widening? Keep in mind the Federal Reserve is maintaining their rates.
I think it's going to stay strong.
Yeah. Other central banks are cutting rates, the Fed not yet. So is that going to weigh in on the dollar, you think?
As I say, I think the dollar is going to stay up on the high end of things. I'm not predicting it's going to go much higher. It doesn't have much higher to go before it hits an all-time record.
Let's move on to some
on a trade-weighted basis. So it's very, very strong.
Okay.
And I think it will remain very, very strong. And I think this year we will see actually an increment on the upside in terms of the reserves held at central banks that are dollar denominated.
I do have one more question on the dollar. Now that you've reminded me, you have been calling for a recession for later this year. Suppose it does happen later this year or even next year. Would that weigh down on the dollar? Would economic stagnation weigh down on the dollar, generally speaking, or does it have no impact?
Remember, when we say the dollar, it isn't the dollar alone. The dollar is always traded against some other currency. So the dollar, the dollar will probably remain the best dirty shirt in town.
Okay.
Because all the other countries, name one other country that we have a forecast that they're going to be in a major country. I mean, I'm not talking about these small fries that don't really make any difference. But of the big economies, are we going to have a boom in China? Are we going to have a big boom in India? Are we going to have a big boom in the UK? Are we going to have a big boom in the Eurozone? Those are the big economies, and a boom isn't in the cards for them. And in fact, it looks like they could even be weaker, at least some of them, than the United States. Even if the U.S. slows down, we have a recession.
Yeah.
So this is an important point, by the way, that most people, the average person, doesn't think in terms of the best dirty shirt in town, because they're not looking at the other side of the dollar. And what's the other currency you're trading with the dollar? What's the match? Is it the euro? Is it the yuan?
By the way, you haven't mentioned the yen. That's fallen to a 25-year low, I think.
Yeah. Well, I forgot. I did forget to mention Japan. It would be one of the big players. I left them off the list. But you're right. I mean, the yen has just hit a 25-year low.
Okay, let's move on from the dollar. There's a lot of domestic issues we should get through today. But thank you for clarifying the petrodollar story. You tweeted this: California madness. Los Angeles has just opened a luxury high-rise for the homeless. Each unit costs around $600,000. And then you wrote, "Welcome to the Socialist Republic of California." I'm sure there's more to the story than. By the way, I encourage people to check out Professor Hanke's Twitter Lots of good, useful information, sometimes entertaining tweets like the one I just read. Get, what's happening here? What's the bigger story?
Well, the bigger story, in a way, it is de facto, anyway, a socialist republic. And there are all kinds of nutty interventions that take place in California. One, for example, we've just had California minimum wage law. Minimum wages have been increased up to $20 an hour, and as I anticipated, places where they were paying the minimum wage, like fast food operations, have fired a lot of people.
So generally speaking, what's the theory here that imposing a higher minimum wage will also increase unemployment in that sector?
Well, that's not how it's advertised.
Okay, all right.
That I doubt if it was advertised as an increase unemployment bill, but that's the effects are that. And this is a problem with what many people get into problems with, what's called one stage thinking, something Thomas Sowell introduced. And then the first stage is what? Oh, we're going to increase everybody's wage, minimum wage, up to $20, and everyone is going to be better off that receives the minimum wage because we're increasing it. But everybody receiving the minimum wage isn't going to remain the same everybody. You're going to end up losing a lot of people that will be fired because the minimum wage at $20 is too much for the fast food operations to bear. So they start whittling down their labor force. So that stage two is whittling down the labor force. But the stage one thinkers, all they say, you have so many people working in fast food, and that number will remain the same, and we're going to increase their minimum wage, and their take-home pay will be larger than what it was before we introduced the minimum wage. Well, the catch is that's stage one. Stage two is a lot of them get their pink slip.
It doesn't that depend on the labor market conditions of the time? For example, right now it's been reported that the labor market is relatively tight. People are finding it difficult to fill vacancies. And so in that situation, I guess the employers would have no choice but to just keep their employees, because if they fire people, they still need people to work, right?
Well, the total effect of raising a minimum wage. Let's say the minimum wage was lower than the market wage.
Okay.
And you raised it, and it still remained lower than the market wage. It wouldn't unemployment wouldn't change at all. In that case, the minimum wage would be non-binding and irrelevant. It's only when the minimum wage goes up above what a normal market wage would be.
Okay, what is your opinion on what should be done then? There are different minimum wages for different states. I think there's a federal average.
I think they're a terrible idea, and they should just get rid of them completely and let the market wage prevail, and that would be the best of all possible worlds. And by the way, a very good thing, particularly for people who are at the low end of the labor market and aren't trained. The great thing about having a free market in labor is that even if you enter and the wage is low, you have a job, and you can get trained, and you can get work habits developed. If you have a job, you got to show up on time, and learning how to do that for some people is a big deal. But it's a good deal. Gets you out of bed in the morning, gets you on the job, and then you work up. And by the way, there's a lot of upward mobility in the labor market. People starting low and moving up high.
I don't know if I've talked to you about this issue before, but in California, it's been proposed that grocery stores can't shut down without notice. They have to give 6 months notice before a closure. Otherwise, they could be sued. So I suppose if your minimum wage goes up and you have to hire people and you have to shut down for whatever reason, you can't even do that now.
Well, you could after you gave notice, and for
Yeah.
you'd have to wait. You'd have to wait a little bit. Given again, I don't know the details of this shutdown law, but from what you said, it might not happen on day one, but after 6 months, if the situation was still one in which you thought it was prudent to thin out your labor force because the minimum wage was biting you too hard, you just have to wait 6 months basically, and the business would have to eat whatever the cost was that was being imposed for a 6 month period, but then they could get rid of that cost by firing workers after
Well,
6 months.
Professor, here's a scenario that I guess could be used as a counter argument. Suppose we abolish the minimum wage, and suppose wages for certain low end jobs were so low that these workers have little incentive to actually take those jobs. It's probably better to just not work and receive a higher number in social security or unemployment checks, right? Wouldn't that also just encourage people to not work?
Well, of course, economics is a game of incentives. So now you've plugged something else into the scenario, and that's the welfare payments of some. I mean, believe me, I can increase welfare payments to such an extent that virtually no one would be working. What
Okay.
what what if you could get a basic income of a couple hundred grand a year? Would you be running your program now?
Well, I still would because I enjoy speaking with you, but that's a separate
Yeah, well,
story.
yeah, that that's true. I would probably be speaking to you too.
Well, well, just do it for the fun of it. But I understand your point. But I'm not talking about people who run businesses. I'm talking about people who work at these fast food chains who now all of a sudden, supposed in theory, are being paid $1 an hour. All right, that's the wage that me as an employer of this fast food chain is going to offer $1
Well,
an hour. Why would anyone work for me?
yeah, well, they probably wouldn't, because I think let me counter that by just saying a dollar an hour is there's no place that the market wage in the United States would be that low.
Okay, so the market would decide that
The
that is a
mar the
ridiculous
market
rate.
the you know the so and let's say you started with that hypothetical at a dollar, and in that case, no one would want to work. Well, the supply of labor, the supply curve would shift back to the left, and you would get an increase in that wage, and it would go up, zoom up above a dollar to attract people into the labor market.
This is an article. Speaking of basic income, this is an article that came in from Business Insider earlier this month. I'm just going to read you the first paragraph. Here's an idea: a worldwide universal basic income paid for by a carbon tax. A study found that it could boost a global GDP by 130%. Some might say UBI is wishful thinking, but one study suggests otherwise. Researchers behind the newly published study called Utilizing Basic Income to Create a Sustainable Poverty Free Tomorrow outline how universal basic income could provide a two-pronged solution to both environmental sustainability and social resilience that could grow the global GDP from 39% up to 130% growth. A basic
Yeah,
income
well,
pilots gained popularity after the COVID-19 pandemic. Basically, they're charging a tax on carbon credits and then applying that to give out basic income. What's your
yeah, well,
thoughts?
yeah. Basically, if you go to the source of that article, you'll find out it's some environmental nuts that are proposing that, and the reason they're proposing it, here's the deal: we're going to have a carbon tax, okay, and that carbon tax, we're going to give you money. Are you for the carbon tax or not for the carbon tax?
I'm for not polluting the environment, but that's a different
Yeah,
discussion.
well, I am too. We've been through this before. I was a free market environmentalist before that such a thing even existed. But
Okay.
I'm a lot older than them. But this is what I call fairy tale economics.
Okay. What? But All right.
They're trying to make the carbon tax attractive, and get people behind that. And if people read this, they say, "Oh, this looks like a great deal. They're going to tax the bad guys who are emitting carbon emissions, and they're going to give us the money from the tax."
Okay.
This is how you buy votes. This
Forget
is a vote buying mechanism to get somebody on your side. So it's a little bit like, what President Biden keeps forgiving all these student loans, or trying to. Most of his programs have been deemed illegal by the courts in the United States, but he tries again and again. So younger people who've gotten themselves into a lot of debt, by incurring debt to go to college, are getting that debt relief and debt taken off their back by who? By President Biden. Now, do you think they're going to be voting for Biden or somebody else?
Okay, forget the carbon tax aspect for just a minute. Let's just talk about UBI. I'll give you another example. If you're watching this right now, comment below on where you stand on the UBI debate. Take a look at my screen here, Professor. Let me just read you an article. Denver gave people experiencing homelessness $1,000 a month. A year later, nearly half of participants had housing. Here's the experiment. Denver released the project's one-year report on June 18th this year, showing that 45% of participants secured their own house or apartment after receiving basic income for 10 months. They also experienced fewer emergency room visits, nights spent in the hospital or a temporary shelter, and jail stays. The report estimates that this reduction in public service saved the city $589,000. The program initially lasted 1 year and was extended in January for another 6 months. Participants were sorted into random groups. One received $1,000 a month for a year. Another got $6,500 upfront, followed by $500 a month, and a third group got $50 a month as a control group. Okay, what's your response to just?
Well, this is what Frederick Bastiat, the famous French economist, actually wrote about this in the 19th century. This is what you've just put up there is what's seen. Now, what's in? So okay, that's fine. Let's assume all those facts are correct, which may or may not be true, but let's just assume, for purposes of discussion, that they are. That's what's seen. Now, what is unseen? What is unseen is who's getting taxed. Where's the money come from? And what are the costs associated with taxing the? In the case of Denver, I'm sure it's coming out of property taxes, probably. So
Okay.
what happens if you have to jack up your property taxes to pay for something like that? Number one, the annual benefits that you receive from rent. Let's say you're renting it's easier to think in terms of renting rather than a owner occupied dwelling. Well, your net income is going to go down because the property tax goes up, but everybody, their net benefits go down, and the tax increase in the property tax they pay, well, something called tax capitalization. You take the present value of all those tax increases over time, and whatever that present value is, you subtract that from the capital value of the house, and your house value is going to go down. It'll be lower than it would be before the tax increase. So that's what's unseen. In one of these schemes, like you've just portrayed, there's you put forward what's seen, but I want to know. Okay, that's a benefit. What's
Okay.
unseen is the cost. Well, we don't know what the cost is.
Okay, well, let's just talk about the concept of wealth redistribution. Now, we've talked about this several times. We've had a panel about this with Art Laffer, but let's just revisit this once more. I had a discussion recently with the former chief economist of the Labor Department, and we were talking about the concept of societal happiness, right? People who are in the middle class or lower income tier, if they receive X amount of money, they would, in theory, be happier obviously the marginal utility goes down the more money you give. But the point remains, if you take money from the super rich, they are incrementally less happy, but that increment of less happiness is still less than the greater happiness you provide to the lesser people if you take that money and give it to the poor, right? So better overall, we're still better off as a society. How would you respond to that?
Well, who's going to decide all this? You're going to have some bureaucrat in Washington deciding who's going to get what. And by the way, maybe I wouldn't think it's that great an idea to get gouged with some more taxes, so the money could go to who? I don't even know who. Now, if I voluntarily want to help somebody out and give them a hand, a loan, or just give them cash, that's something else. I should be free to do that. But why should the government have the right to decide how I should be redistributing my income and wealth? Again, what you this is what's seen and unseen. You just gave what's seen. You just hypothesized that what's seen is that some guy is down on his luck, and you give him money from the government, he's going to be happier. Well, where's the money coming from? Maybe the person that you're taking the money from will be less happy than the one you're giving the money to, who's being made more happy. Maybe the costs are greater than the benefits. Well, who's going to decide that?
Speaking of taxes, well, I mean, that's a good question. Well, I guess the decision is just
the only way you would know for sure if this was a beneficial transfer is if someone voluntarily did it. If I decide I'm going to give Joe Blow or Jan Blow extra money out of my pocket, and I decide to do it myself, obviously I think the benefits are greater than the cost. Otherwise, I wouldn't do it. But you're going to have some government bureaucrat deciding that?
That's called charity, is not. You're donating to a charitable foundation.
Yeah. Well, I would rather, if I'm doing it, give it to some individual rather than a charity, because charities end up, again, that's an individual decision. But in my individual case, I know that the overhead on these charities is pretty high. So I'd rather do it directly.
Okay, speaking of taxes, this is a plan. I don't know if I talked to you about this last time, but I'll bring it up again anyway. Trump wants to, he said in a private meeting, he wants to abolish the income tax and replace it with tariffs completely. Right, the details are to be worked out. This is just an idea of his, but in theory, would this work?
No, number one, most of, by the way, most of the when the United States came into existence and stopped being a colony, most of its revenue actually was from tariffs. So it's feasible to do this, but you'd have to shrink the government tremendously. If you made the government very tiny, you could probably collect enough in tariffs to finance the government. Tariffs, of course, are a bad idea. So
isn't that just a form of taxation? Everything goes up.
Tariffs are a tax,
right?
And I think they're a bad tax.
So you're instead of providing income tax rates for different, I guess, different income divisions, we just have a flat tax for everybody because everybody gets hit by the tariffs equally.
I think the best way realistically to raise revenue for the U.S. government, given realistically the size of the government or where it might be, would be a flat tax, a flat income tax, no exemptions or anything like that, just a straight tax of 10 or 15% of income for everybody, and that's it.
Okay. Let's move on to the economy, and then I want to finish off on Javier Milei. So let's talk about consumer spending. There's this theory called the Ricardian Equivalence. Basically, it states that higher government spending causes consumers to spend less, right? Because consumers anticipate future tax increases. Now, first of all, does this theory actually, work in practice? Is this true that there's a
Well,
relationship?
it is true in theory. There's no question about it. It's just the arithmetic of the thing. But but in reality, you have to make so many assumptions to make the arithmetic work that it's kind of what I call fairy tale economics. Now let me give you one place where see what it's in short and simple language. If you had very tight fiscal policies where the budget was more or less balanced, you would have less private savings, more private consumption, and the overall savings. The idea is the overall savings would be the same in the economy. If you tighten up fiscal policy, you'd have less private savings, more public savings, and the overall would be the same, public-private. If you add them together, you get the same number. Now, if you loosen up fiscal policy, the theory is the Ricardian Equivalence. If all the assumptions are met, then the arithmetic works that you'll have more private savings that exactly offsets the dis-savings or reduced savings in the public sector. So if you and so that's the theory, but the problem is it doesn't always work that way, because you got all these assumptions that have to be satisfied to make the thing work.
Fair enough. Generally speaking, okay, let's comment on the Phillips curve. We talked about this a long time ago, but let's revisit this once more. I know you've said that it's not a consistent relationship, but a few questions I have. Is this, is this playing out now? We have lower inflation and higher unemployment. The Phillips curve, by the way, for the audience watching, it's inverse relationship between the unemployment rate and inflation. I'm not sure which causes the other. I'll let you comment on that. But it was observed in the 50s where it was first commented. Why did the relationship hold in the 50s and 60s and then later on broke down? And is it coming back now?
Well, the thing is that there's the Phillips curve. It simply says there's a negative or inverse relationship between inflation and unemployment.
Yes.
So if you want to get inflation down, unemployment's going to go up.
Yes.
And vice versa. Okay, so that the problem is that the curve shifts around. It goes up and down, and you can, at the extreme in the 1970s, when it was obvious that the thing was nonsense, we had stagflation. You had both unemployment going up and inflation going up. Now, it turns out that you had two Nobel laureates that worked on this, and I wrote with John Greenwood. We had a letter in the Wall Street Journal yesterday exactly on the Phillips curve, and what Milton Friedman, one Nobel laureate, and Ned Phelps, another Nobel laureate, showed that once you get inflation expectations put into the picture and make this thing dynamic, the curve is actually vertical. And in other words, there's no relationship between unemployment and inflation. No matter whatever the inflation rate is, the unemployment rate will be unaffected in the long run. Once you get inflation expectations in the picture, and that comes back into this kind of shifting. The simple way to think about it is shifting around of the curve. So it's basically nonsense, but it very much, especially in the short run, has appeal to people, and a lot of the commentary about current inflation in the United States and elsewhere is focused on the Phillips curve, which basically is rubbish.
It's the foundation of a lot of assumptions I've heard, because people have told me, well, if the Fed achieves their 2% target, we're going to get higher unemployment.
Yeah, right.
So that's kind of where, I want to address this.
It's in the common man's lexicon for one thing, but what drives it, keeps it going, is that you have at least most of the macroeconomists are post Keynesians, and they still try forever to revive the Phillips curve and use the Phillips curve. And for example, if you look at the chairman of the central bank in Canada, he claims, by the way, that he kind of dumps the Phillips curve, and he says, I can get inflation down without increasing unemployment. So what he's kind of puts the Phillips curve to the sideline. Well, interestingly enough, at least in the short run, if you look at Canada, what's going on, in June of 2023, the unemployment rate was 5.4%. Now it's 6.2% in Canada. So the unemployment rate is going up, and inflation is coming down. So that looks like kind of that the Phillips curve's working. But now the governor says, well, don't worry about unemployment continuing to go up. I can get the inflation down without raising unemployment.
Final topic, Professor. I'll let you go. Thank you very much. Javier Milei in Argentina. This just came in from the news. I know you follow Argentina closely. We've talked about this many times before on my show. I'll just read you the headline here. For the first time in 30 years, Argentina experienced a 0% increase in the inflation rates of food and drinks during the third week of June. Is this due to his policy, or what's going on here?
Well, this is a 2-week wonder. I think I would say in Argentina, Milei shouldn't count his chickens before they hatch, because when he came into power, the money supply was growing at 146% per year, and now, when he came into power, by the way, that was a January number, and now it's zoomed up to 161% per year, the money supply growth. And if you don't control the money supply, you can't control inflation. As we've said, repeating Milton Friedman over and over in this program, inflation is always and everywhere a monetary phenomenon. So if the money supply has actually gone up, it was triple digit when Milei came in, and it's still triple digit. It's even a higher triple digit. And so don't count your chickens before they hatch, Milei. Until you get rid of that central bank and dollarize the economy, you're not going to be able to control inflation on a sustained basis, because you can't control a money supply.
By the way, the unemployment rate in Argentina, I'm just looking at the stats, it's been ticking up the last couple quarters. So I Phillips curve, I don't know if that's been holding. Anyway,
again,
I digress.
Sometimes in the very short run, it looks like the Phillips curve kind of relationship is holding, but in the long run, it will not hold, and it will tend to be vertical, as Friedman and Phelps showed in the late 1970s, and by the way, from which they won a Nobel Prize. Okay. In part. I mean, they did it. They're big economists, so they did lots of things. But one thing they did is that work on the debunking the Phillips curve. And why was Friedman so interested in this? He had to debunk this Keynesian type Phillips curve so that he could go back and concentrate on looking at the money supply, because it's a money supply that makes the world go around and causes inflation to either go up or go down.
Perfect. You've summarized or clarified a lot of concepts for us today. Thank you, Professor. We can follow Professor Hanke at the Twitter link down below at Steve_Hanke. What was your email again?
Please remind us. At Steve_Hanke. Email if you want to be on the distribution list, hanke@jhu.edu. It's been great to be with you. I feel like you've given me a little mini PhD exam. Did I pass?
Well, we'll let the audience decide. To Professor Hanke,
Ooh,
Steve
that
Hanke
could be
passed.
that could be dangerous.
email the good professor down below. Let him know if he passed our exam today. And please do submit your questions to us. We receive questions sometimes on a regular basis, actually. So we'll get through some of them next time.
Well,
A
that's
lot some of these questions were submitted to me. Yeah.
yeah. I was going to say some of those questions came from viewers.
Yeah, they're pretty good questions. So
Yeah.
please email us your questions. You can email Professor Hanke or myself. My email is down below as well. I'll speak to you again soon. I'll see you in 2 weeks, Professor. Thanks for your time
Okay,
today.
David. Thank you.
Thank you. Have a great weekend.